Good evening, everybody. My name is Kathleen Prokop, and I am a VITA TCE tax preparer volunteer for the Community Action Partnership. I'd just like to say my opinion about how to prepare for taxes. So, first of all, um, their question is who must file for taxes for the year work 2022, filed tax the year 2023. Um, if you're single and under 65, you need to file for taxes if you made at least 12,950. If you made less than that, but you made at least 2,500 and you're a full-time student, and then so you can apply for American Opportunity Tax Credit and also earn income credit. How to make decision whether you are going to itemize or use standard deduction. I think you use standard deduction if you earn income with the standard deduction qualification. So if you're single, 65 or older, the standard deduction is 14,700. And for married filing jointly under 65, both spouses, so this combination is 25,900. For 65 or older, one spouse is 27,300. For 65 or older, both spouses is 28,700. Now, it's important to watch your age. If you are 65 or older and you have joint income, I do believe you might want to double check with that. 3,200 filing jointly, then that'd be a total. Your Social Security, your earned income, which one half of your Social Security plus your gross earned income. If the married filing jointly makes 3,200, then 85% of your Social Security is taxed. If you are single, then your one half of your Social Security plus your earned income must total over 25,000. So 25,100, $25,000, and so forth. And if you're married, it has to be over 32,000, like $32,001, and so forth. So, who are considered filing jointly? If you are married still, even the last day of 2022, live together for 365 days, or separated after within separated but live together in the first 383 days, but you anytime after the 7th month until the end, if you live any period of that, then you cannot file for separate. You need to file for marriage. And the husband or the wife who makes more than $5, then he would be the head of the household if they're separated. And the wife that may the person who makes 5,000 or less, then he has to file for not head of the household. So there are 5 types of who must file. There's single, married filing jointly, married filing separately, head of the household, qualifying survivor spouse. So if a couple are filing separately, the person who makes more AGI, then he can file or she can file head of the household. The person who makes at least up to $5, then my married filing separately. If the children are uh, taken or under custody or whatever, is not just custody because it's only separate, living with the one that makes more money, then he can claim the children. But if the children are living with the one that makes $5, up to $5, then the one that has the most AGI would need to claim the children. So the qualifying survivor spouse, if one of the couple is deceased that same year, so if the person died this year, 2022, then they can file, the person is alive can file for filing jointly. And if the first and second year after the qualifying person become a widow or widower with a qualifying child, then he can claim the qualifying survivor spouse. And the third year, that would be then head of the household, you know. Can be filing separately because no longer married. So that is the criteria whether you must file or not. If your child is 19 or 18 and made 4,450, I do believe, and he has withheld taxes, uh, the parents can claim him as a dependent. But if the child don't want because he's 18 and 18 is adult already, then he can choose to file his own. But if the child is 19 or more years old, then the parents cannot claim the child as dependent because he's 19 years old, even if he would be a student, because he would be well supposed to be, if the student is supporting 51% of his household self, then he has to claim his own income. So, for example, he's got a Pell Grant of maybe the full credit 6,000 something, and he worked 4,430 or 10,000. But minimum is 4,450, I think, or 4,430, and he's 18 and he withheld his own tax, or he so that would be if it's 10,000, then that would be 12,950, which is a standard deduction. Then he can claim his own income, so long as he's supporting himself 51%. Now, some of these 18-year-old could be working 10,000, and if the parents would say that he's supporting himself 51,000 because he's paying rent in their household, and if the rent, for example, is 250 and he's afford to pay the 250 and paying his own car payments, even if it's only liability, he's paying his own car payments. He is able to buy his own food, and and so he's supporting himself 51%. So then the parents cannot claim him even if he's only 18 or below 19. If the person is student, it has to be less than 24 years old, so 23, has to be full-time student or part-time student, and so long as he's supporting 51% for himself, even he's below 24, then he has to file his own income tax. So uh, let me see, the earned income that could qualify the person. Let's see, what was there? Earned income uh, is uh, taxable wages, salaries, or tips, uh, union strike benefit, uh, long-term disability benefit prior to minimum retirement year. So he would be qualified because he would be below 65 or 62 years old. Net earning from self-employed, gross income of statutory employee, household employee income, such as if he would play in the band and he's got income, or he does car wash and he's got income. Non-taxable combat, non-employee if he's self-employed, such as gardening or handyman. Rental value of a home or household allowance provided to minister as part of the minister's pay is out of scope for me. So I also believe that income also, not only earned income, is that can be claimed as income to qualify him to say he can support himself, is cancer debt. That's earned income. Let me see, discount, awards. For example, he's working Jack in the Box and he's got award, bonuses, let me see, awards, grants, cash income, uh, breach of contract payments, disability benefits, employer funded though, not state or federal. So those are just examples of income that anybody can claim. But just an example of 18 years old who is able to support himself, or even 17 years old, he's able to support himself because he worked and he had tax withheld. So that would be between the parents and him contract. I mean, understanding. Because if the parents charge the child room and board, then he's claiming himself as supporting himself at age 17, even though he's below 19, or even if he's a student below 24. So the key there is supporting himself 51%, and he had tax withheld. Okay, so now let's go to uh, next part. That would be oh, there you go. The person must have at least 4,400 of income. Okay, uh, of person. If a person is making 4,400, even he's 17 and he's got, you know, the room he's paying 250, his car insurance is making him paying maybe only liability, and he's buying his own food. He's, even if he's not contributing to the water or trash, things like that, because that could be a benefit for them, you know, and he's able to afford the rent, the monthly payment, you know, because the parent is nice enough to let him pay 250 a month for a room. So that could be qualified, because that could be, he could file for himself as independent. The Form 1040 has to change this year. Uh, it's now oh shoot. I think from number 8 down, it goes after 1 to Z. So that might be something. Oh, number 1 also, 1 to Z. I thought it was also number 8 down. So check your 1040. There's a update of the 1040. Okay, so if you are wanting to file for itemization, you can, and you made less than the standard, because this just say you made some, we didn't make tax withholding, and yet you made less than 12,900 if you're single, and you have some deduction, and you have such as charity, such as glasses, prescription drugs, what is the other ones that would, can reduce your AGI, okay? Can reduce your AGI, which will reduce your tax payment. So that's okay to do that. But if you had withheld and you did, your income is 12,900 if you're single, then you don't have, and you had tax withheld, you don't have to worry, because your 12,900, if you made less than that and you have tax withheld, would cover your requirement to pay taxes. Now, if you made over 12,900, even though you withheld, then it's a good idea to do itemization. So the only good thing to do not to itemize but claim standard if you made exactly 12,100 if you're single, okay? And then there's other qualifications for if you're married and so forth. Things you can use is property tax for itemization, mortgage interest payment, your rent, your utility, property insurance. Man, I forgot to use my property insurance. Property insurance, food eaten in the home. Really? How is that? Other household expenses, Fair market rental value. Yeah, I did claim how much money I eat, food I spend. Yeah, because it tells how much money you spend on food. Uh, so your other months amount paid, your contribution, you could use that if it is listed as a non-profit that you can claim as a charity organization. It only lists so much. But if you contributed less than the requirement, you might want to double check that. Then you didn't have to list your uh, charitable company, and that would be okay. Let me see. Who qualifies a person for a head of a household? Qualifying child, such as son, daughter, or grandchild who live with you more than half of the year and meets certain other tests. So, has to be below 19 if he's a student, below 24, and you are supporting 51% of his living. If you pay for his room, he doesn't pay for rent, you pay for his car payment, you pay for his car insurance payment, then he's not supporting himself. But like I said, if he charged him 250 room and he pays liability for his car insurance, he pays his own food, he pays his car payments, even he only got $1 left, then he can support himself 51%, then he can claim taxes for his own. If you are nice parents, because some of those parents, I don't know who really are, would just like to use their children, but the sooner the child file for taxes, so long as he's continuously doing it, the better for him, because all he would need is 10 years of work, then he would be qualified for, if he got disabled, 17, before the age of 25. That's before, I don't know now. If he got disabled, then he's able to collect disability for state as well as federal after 1 year of state. So that's something to consider about. Okay, so be nice to your children. Now the next thing is dependent. Okay, dependent are the children that lives with you, and you are not supporting them 51%. Even if you're paying 49%, but you're not supporting them 51%, so you might want to help your child, right? So long as they are supporting, you can help them on the electricity and the water, on the trash. You didn't have to let them pay that. So, let me see. So even half sister, half brother, step brother, step sister, and the depending of any of them that lives with you, that's a test for qualifying child. Okay? The person can be qualifying child or qualifying child of another taxpayer. So if the taxpayer is claiming, then you can claim them. A child isn't the qualifying child of any other taxpayer. So if someone is claiming them, you cannot claim that child. Or another person for whom the child is defined as a qualifying child. So if the child is a qualifying child for someone, then you cannot claim them. Is it required to file income tax return or file income tax return only to get a refund of income tax withheld? So the child under 19, if it's a full-time student, under 24. okay? Or anyone that's permanently disabled. But if they're disabled and they have social disability and they're able to support themselves, even if they're not filing for taxes, they're able to support themselves, you're gonna claim them. Because most of these people that are disabled permanent, they have money from the government. So, and they usually have someone to, uh, watch over them, even if they're living with you. So that's only considerate of you, okay? Because it's good for them to be recognized as independent, even if they're disabled, because they have money from the government and they have a social worker that helps them, okay? So even if the child lives with you more than half of the year, like 384 days, it actually goes by night, okay? If they live 389, 3 4 nights, then then that's more than half a year. But 383 nights, that's more than half of the year. But they have their own money from their disability, and their social worker is dealing with them, helping them financially, such as with their food, if you're allowing them to rent, uh, you know. So you may be afraid to tell that you're claiming rent that would increase your income, but you have to respect your children. You have to respect them. Okay, so if they got money from the government and they have a social worker, you have them pay income. Uh, Even if say they have no car, they can ride the disabled bus, or the Go Micro, and so things like that. Uh, there's different in the United States. People that are disabled, permanently disabled, they letting them work. The Like the Exceed program, they're getting paid when they go to those places, and they do something. They're being trained to develop cognitive in hope that they get healed. You know, so if the present gross income for the year is less than 4,500, but I don't know exactly how much, but they're supporting themselves even if they're disabled, uh, because you're only helping them and you're not charging them $900, $1,000 for any one bedroom in your home. So you need to be considerate to your children. Okay? Okay. The next is income. But if you guys are tax prepared, you need to ask this. And the person is, so long as the kid is supporting himself 51% according to the law in their home, can be the law in the government. The law in the government is 51%, but if their agreement in their home is supporting 51 because they're paying their own rent, they're paying their own car, they're paying their own insurance for the car. So, uh, now the other income is, we already talked about that. What else is there? The 1099R, that's the 401k, that's the distribution. If you are 59 years and a half younger, you have to pay penalty and tax. But if you are 59 and a half, then you only have to pay the tax on your 401k that was distribution. you don't have to pay for a penalty. Okay. Uh, uh, if you're self-employed, you use the 1099 NEC, and it has a question in there that says, would you like to link it to Schedule C so you can claim your expenses? Some expenses are uh, toll for your on the freeway, um, mileage, uh, business cards, anything used for your advertising, your Cengage sign for your car if you bought it that year, your car maintenance, um, um, even car registration too this year. You can claim for uh, even if you filed for itemized and you're not self-employed, you can claim because that's what it was. Okay, so that's your itemization if you're self-employed, the Schedule C. Okay, self-employed is usually a sole proprietorship, so you have to use your Social Security because it's self-employed. If you're a corporation, then you have to use your corporation federal ID or your corporation state ID. And the tax is the same in the tax bracket, or maybe there's none. I think it's the same. For if your company made 9,900% and 9,999, then you pay 10% of that. Okay, it's the same thing whether you're married or you're single or whatever. So uh, let me double check that. So uh, chart for corporation. So tax bracket chart for corporation 2022. 22. Oh, that's weird. Corporation in the United States may federal corporation income taxes levied at a 25% rate. Wow, really? I didn't know that. I thought we have a chart. I didn't know that. I thought we have your own chart to use. So the standard deduction of a corporation, I can find it now. So let's just say for California, a tax bracket chart, California, uh, corporation 2022. says 21%. Corporation in the United States pay federal corporation income tax levied at a 21%. So that's lower, huh? Before it was set for 42%. Then it went down to 32%, 25%. Now it's 21%. So is that good or what? I don't know. Well, in New Jersey, it's 3.1%. California, Illinois, Iowa, Maine, Minnesota, and Pennsylvania face combined corporate tax rates or above 28%. So California is on or above 28%. So let me see. California is 28%. Well, it doesn't open, so let's open it up. 28%. Alaska, Arizona is 25%. The reason why it's good to not too high because of you high enough and not too high, not too low enough because of your stocks and bonds. So that's why it's pretty good not to pay too low of income tax for corporation because the money that you make uh, 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 make decision on your common stocks and preferred stocks. So, and things like that. So it's good not to pay too low and not too high. 20%, I'm not sure if that's good, but California makes good decision on that. So I guess it's good. So now let's so qualified Medicaid waiver payments, if you are paying, you didn't have assistance in paying your premium for your Medicare, you can use you can type down the Medicaid premium in there, and that would lower down your AGI. Or maybe I don't know if that is like you get the money back or lower your AGI. I hope you get your money back, because so let me see here. Just go ahead and look in the publication for the IRS. Because, when you pay your Medicaid premium, it lowers down your payment for your Social Security. Okay, now let's go to adjustments of the income. Let me see. Premium tax credit. If you have HSA and you pay the same total of Part A and Part B, constant, it doesn't change, then you can just say that, and he just asks you what is your tax premium tax credit, which is column C. And of course, he would ask you in there the poverty level, the question, are you poverty level 100? So you have to answer those. Okay. And let me see. Your health savings account, you are limits of deduction for individual for self-only coverage is $2,650. If you have family, then $7,300. And contribution, additional contribution is 55 or older of $1,000. So anybody can help you in your contribution. Your employer, your grandma, your neighbor, but you can only contribute up to $3,650 if you're single, and $7,000 for family. And the things that are covered in there that you can claim as your expense, where's that at? Such as doctor, over the counter now is covered, glasses, gym membership is that yet covered. So don't claim your gym membership. I forgot with the physical therapy because anything now is anything that's medically necessary. So physical therapy is medical necessary for you, but the thing is chiropractor. Now chiropractor is included in Medicare or Advantage C. So if you go by provider according to the Medicare or provide C, then it would be covered. I think I got that answer right. So let me see. Because the criteria is provider that are covered, and chiropractor is covered by Medicare. So HSA qualified provider for 2022. Yikes. Oh. I say HSA qualified expenses. Dental is covered. Preventive health program, vaccine, blood test, metabolism test, lab test, even fees paid to Health Institute or vitamins prescribed by the doctors over the counter, special fees incurred by handicapped individual, including wheelchair, telephone, TV equipment, cost of care of a guide dog, special school costs for handicap. Alternative treatment, this could include acupuncture, Ayurvedic medicine, aromatherapy. See, before those were not covered. Homeopathy, Homeopathy is a wellness, like uh, mm, tea, because that's homeopathy. Traditional Chinese medicine, nutritional consulting, or even healing services provided by Christian Science practitioner or other type healer. Transportation and lodging expenses when related to healthcare. So you go to the doctor, you go for your aromatic therapy. Mental therapy, this includes charges by psychiatrists, psychologists, psychoanalysts, or psychotherapists. Physical therapy, this includes hydrotherapy, chiropractor service, or medical massage therapy. Maternity expenses that are not covered by your health insurance policy. Okay, insurance premium to pay for your qualified long-term care, such as convalescent, because that's long-term care. If you go to convalescent to skilled nursing because you want to have rehabilitation, you could include that in there. So are there a penalty for non-qualified HSA expenses? It can be tempting to withdraw funds from your HSA for purchase other qualified expenses. If you take this route, be prepared for a large tax bill. That's weird. So, okay, I'm just going to go ahead this one. And then I'm going to print it because I would like to. And it's gonna help me in my cheat sheet. So where's print? Print. Yes. Oh, this is print on the other state does. So I'm gonna get that cheat sheet in my VITA. Come on, hurry up. So okay. Okay, printer that's set up for the print. Okay, print. Print. This is so slow. So if there is any questions that you may have, just go to irs.gov and you need to ask for publication. Good one that you could print is a training. It's a VITA training. I guess you could print it. You could go and print it. Would be publication 6744 or 4491 training guide. And you can even print publication 4012 because they won't know that whether you're tax person or not. Oh no, I'm not printing. I was able to print already before on my cell phone. Okay, let me see. was able to print already before. Yes. My print is on. Sorry about this. I need to print, I know. Next. Call. Okay. Let me see. So print. I was able to print right before. Understand. Stop. Cannot print. Restore network. I'm just gonna go ahead and send it to my email. So. Ah, there you go. Paper size. What's my IP address again? Oh, there you go. Here we are. I'm on the roll. So now we're going to cover the next part, which is dependent. We covered that already, okay? Now, in here, the tribal contribution. Not dependent, but deduction. Tribal contribution From what I understand, you can claim up to 50% if you itemize. But for veteran, it's about 30%. Domestic fraternal society like lodge does not qualify for 50% limitation. So they qualify for them. Since the limitation is 50%, maybe they qualified for 30%, right? So that's how that is. So that'll be the other deduction. Some deduction includes what other deduction? In your business, Schedule A for medical deduction, that would be amount paid to the dentist, prescription. That's the itemization in section A. Just click itemization and it takes you there. Sales tax is itemized. Mortgage interest rate. Taxes, no. Let's examine taxes. Miscellaneous deduction. Gambling losses. If you won 300 and you lost 300, so you can claim 300. But if you won 1,500 and you lost 1,200, you can only claim 1,100. Your qualified business income deduction, how you calculate that is 20% of your qualified business income. So what you do is take 20% of your taxable income. That means the adjusted gross income, and you minus the standard or itemized deduction. And then you minus the net capital gain on qualified dividend by multiplying 20%. So I think that's the one. The child tax credit, the expansion is expired. So no longer like back in 2021, where you can claim half of the 3,600, you claim the rest, file for taxes. We don't have that anymore. It's expired. Recovery rebate credit expired. Increased amount of the child and dependent care credit and eligible expenses. Modified phase out of the credit for higher earners. Earned income tax credit expired provision. Higher income limitation and credit for taxpayer with no qualifying child. So that income now is lower. That's what that meant. Then if it's qualified for lower, then you would have an earned income credit without a child. You cannot figure out the income from year 2019 now that's expired for 2022. Eliminate of upper age limit, minimum age of 19. minimum age of 18 for qualified homeless youth and qualified former foster youth. That's weird because I have that in here in my book. So the qualified, elimination of upper age limit, minimum age of 19. So now the minimum age is 17 or below. No, that would be for child care. One is earned income credit. Earned income credit, age. I think so. I think because a child tax is under 17, so must be 13. 13-year-old, below 13-year-old. Okay, child and dependent care credit expense. See this, child and dependent care. Oh, 13-year, below, under 13 is a child care dependent. The credit, child tax credit is 17 under. Or other qualifying, if you have one child at least, qualified child, then you're qualified for 1,500. And that's for child tax credit. If you have a child 17 or 18 and you have one qualified child below 17, then the one that's 17 or 18 can claim up to 1,500 because they're below 19, or a full-time student below 24. But the child care credit, you have to be below 13 and have to be with you 183 nights. That's one half of the year. And so kindergarten or higher grade are an expense for care. So kindergarten. So it could be preschool, 2-year-old child care. Kindergarten age is 5, so 4-year-old child care, that'll be okay. So if you have also incapable of self-care person who you claim as dependent, you could take child and dependent care. It's not only child care, child and dependent care. The retirement saving contribution, retirement, did you make a voluntary contribution or defer for IRA or other qualified plan? Your AGI has to be 34 or less, or head of the household 51 or less, or married 68 or less, filing jointly. And you have to be born before January 2, 2005. You cannot be claimed as independent. And you cannot be a full-time student. Really? I didn't know that. So it's useless for me right now to have a, but don't fear, because if you're graduating soon like 1 year, 2 year, it's okay. And if you're disabled and you qualify to retire at age 65 and you go to work, you can get 401k. Who's to say not, right? Because you're working. If the company offers it, take it. Because you have until 72 and a half years to contribute, actually. Because after that, you have to withdraw. And I'm not sure that if you withdraw, you could still contribute. Now, I would say as long as you're working, why not? If you work at the age of 75, go ahead and contribute. But you need to roll over some to Roth. After 5 years of 401k, you can roll over every year after that. So you don't have to pay a lot. But to be prevent penalty, you have to withdraw or transfer to Roth, because transfer to is like a withdrawal too, 59.5 and above. So now, so don't do early tax deduction. See, if you like 2,500, you could only get about 1,400 if you're age 26. The rest goes to penalty. So just make sure you have emergency fund, right? And your savings and your own. Don't put them all in your money, your 401k, because if you need money and you don't have the emergency fund, you would have to penalty. You would be penalized if you get to your 401k. Make sure you have emergency fund. Make sure you allocate budget for your expenses every month. You know, like your battery, you start saving for your battery every year. If your battery lasts for 3 years, so that means about 2.5 years you need batteries. You save monthly for that. Your home tax, you save monthly every year. Don't take it from your emergency fund. So tires, maybe you could that's what I need to do, my tire. You could have allowance set for that. So remember, the earned income tax credit, if you're single, less than 16,480 if you have no qualifying child, or if you're married jointly, 22,610, and you have to be you must have earned income to qualify for this credit. And if you don't have a qualifying child, you have to be at least 25 or under 65 as of December 31st of 2022. You can't be dependent of other taxpayer. You have to live in the United States for more than half of the year, so that's 183 nights. So forth. So now you go to education benefit. So education benefit is the American Opportunity Tax Credit. The taxpayer MAIG, that's your adjusted gross income. The M is just include other deduction. Otherwise, it's the same thing as adjusted gross income. Must be between 80,000 and 90,000, 106,000 a year for married. Cannot be claimed cannot be claimed by the taxpayer, I do believe. Oh no, you can be claimed by taxpayer, by your parents, if you are their dependent. A student loan interest deduction begin to phase out for taxpayer with excess of 70,000. Okay. So what can you claim? So what it is you enter amount of your scholarship, and then enter amount from line 1, that was teaching research. You subtract line 2 from line 1. Enter the amount in line 3, and then what you do is subtract line 4, which is the scholarship, fellowship grant required to use for other than qualified educational expense. So number 3 should deduct your teaching research from your scholarship or grant. And then on line 3, you subtract what you use of your scholarship, right? So if you have a scholarship of 2,000 and your expense was 5,000, so that 2,000 is not covered. So 3,000 would be your opportunity tax credit. Opportunity, yeah. So now you enter your qualified education expenses, which would, if you have no teaching credential or teaching research, that would be 3,000. Subtract, okay, enter the smaller line of 5, 6 or line 6. Subtract line 7 from line 5. Taxable part, compensation tax cleared out. Okay. So what you do is you have the credit can reduce the amount of tax you have to pay. So if your tax credit is 2,500, you multiply that by 40%. They changed that last year. Before you can claim 2,000 of the first 2,000, and then 25% of the last 2,000, that should claim out to 4,000. Now they change it. Now you have to claim 40% of your credit, maybe refundable, limit of 1,000 per student. Yeah, weird. No wonder I got 1,000. Oh man. Now I know why you did that. Okay. But if you have employer provide education assistance, the annual limit is 5,250 exclusion. So if you were paid 2,000, you cannot claim it because the exclusion is 5,250. Okay. So don't forget determining your qualified. So payment received for qualified tuition is 7,000, and you have your scholarship grant of 3,000. So you multiply the 3,000 from 7,000. So what else? I think that's it, because you have another to compare it to, right? And okay, so subtract line 2 from line 3. Well, if you don't have, okay. Enter the amount of line 3 that your scholarship or fellowship grant required you to use for other than qualified. So you need to use in there 3,000, right? Subtract line 4 from line 3. Line 4, okay. Enter the, okay. So number 1 is your scholarship grant, right? And then you subtract the line 4 from your scholarship grant. Double, huh? So you enter your scholarship grant and you subtract that. If you have no subtraction for teaching, then it would still be the same, right? Then you subtract your that's weird. Then you subtract your qualified education expenses. So that would be that one, 7,000. Enter the smaller line amount, so 3,000. Subtract line 7 from line 5. So subtract line 7 into the smaller amount, so that's 3,000. Subtract line 7 from line 5. Line 5, you subtract that one. So that's the same thing, right? They just wishy-washy. That's the same thing. The only difference in here, that's what you have to do, is because you're teaching research. Okay, so what you do is you subtract your 3,000 from 4,000. Let's say that's 4,000. So that would be line 3, right? Then you subtract that by your scholarship, which is 3,000, and then enter the smaller amount. So that would be you subtract that. So that would be 1,000. Subtract line 7 from line 5. So subtract line 4. Subtract the line. So 1,000 from 3,000. That's the one. They changed it, huh? It's no longer like 4,000. Okay, let's try do it. Let's do so this one. Okay, total qualified education expenses. So if your expenses is 4,000, expense 4,000, Less adjustment. Less adjustment. Tax-free education assistant. You have that. Tax-free education assistant receive. Tax-free. Grants. Those are grants, right? So you have grants. You subtract the grants, 3,000. So you have $1,000. Okay. So subtract from line 1. So 1,000 minus 4,000, that's 3,000. Then you put the least amount, 3,000 and 1,000, so you put 1,000. See, that's the same thing. That's what I did. That's all you need to do. Yeah, you're making it difficult. That's it right here. Page J9. That's what you should do. So, your total expenses 4,000, and then you minus it by grant, which is 3,000 or whatever. So you got $1,000. Adjusted qualified education expense. Then they multiply that by 40%. So 0,000,000,000,004, 0,000,000,000,1 400 is your tax, is your American opportunity. That's a sample right here, look. Your expenses, your grants, you minus that grant, whatever you got from your expense, and that's what you got. But if you put that one, you only qualified up to 4,000. No, 4,000 or 2,000. Let me see here. There's the list here before. American Opportunity Credit, maximum credit 2,500, credit for eligible child. Well, how do you get that 4,000? So it's no longer, you can put, or you don't put 4,000 anymore. Oh, I see. So I did mine wrong. It's supposed to be 6,000. Because I had them all up. Should I apply for another one? You can have up to 3. Yeah, I think I will. Another. I got 6,000. You multiply that by 40. Yeah. Oh, bug. because my expenses were 6,000 something, and my grant, yeah, that's why I used 6,000. I only put 4,000 there. So no wonder. Don't multiply by 40% because the computer will do that. So I need to. Okay, finishing your return. Now you're gonna get e-file. Okay. First of all, you check e-file direct. That means if e-file direct, you have your refund direct deposit to your accounts. You need your checking account or savings account with your routing number and your account number. You need to be careful because if you made a mistake, it doesn't correct it. Okay, so make sure they're really when they are it doesn't know whether the account is real or not. That's what I'm talking about. Or it doesn't for tax clear anyway. It doesn't know if its routing number is correct or not. So that's about it. Thank you so much. Now I'm gonna do. Okay, remember, if you have an IT number as a Social Security and you can use it for work, you have work status, so you can claim earned income tax credit. If you have ITIN that says can't work, then you can't use earned income credit. Oh, yeah. Okay. Thank you so much. Happy holidays. Hope you have a good year this year. Looking forward to going to school. Going to school is very good because it gives you a good future, even if I do believe United States is worse than the Middle East about women. Yeah. So, because women in the United States prefer to have their men more, we are subject to our men because we followed the Bible. Okay. But they're okay. So thank you so much. Have a good day. Bye.